because I was until 22 seconds ago still making changes to this slide deck. So
It's pretty brief. It's not a full agenda. The big thing is f of x.
Until 22 seconds ago, still making changes to this. All right, sounds good. We might have just your audio might have just got quiet there just for a second. Anyway, let's carry on. I think it's probably okay. I'm gonna go grab your link here. Did you drop a link? I'm looking for it here. Can you DM to me?
Let me see.
Oh, found it. It was just a long time ago. All right. How are we doing for attendance? We got a handful of friends with us. Usual suspects. Well, this is kind of apologize to everybody. This is a little bit more like these stage type Discord events are a little bit more like formal. You can't just jump in and chat, which is kind of annoying. But we wanted to do it over here because we're gonna share a slide deck that I think works a lot better when we do it in this stage mode. At least that's what Paul tells me, and I trust him. We can get Craig. Go ahead,
yeah, sorry.
Paul.
Yeah, I'm trying to somehow live stream it on Twitter as well via YouTube. I don't know why on Twitter I can't see the thumbnail or anything. It's just the link.
Well,
you guys have any idea before we start?
Nope.
No, this is we're counting on we're putting all the pressure on you here. Let's see. All right. What?
Yeah, I'll bring Craig on and.
Yeah, let's give it let's just give it a minute or two for people to trickle in. Although I suppose we do have some like regular Aladdin business to take care of first, so we can get started talking about some of the workaday sort of stuff, and then before we get into going through doing our F of X deep dive.
Yeah, that sounds good to me. Well, I guess we'll go. Yeah, so I guess we can just go ahead and do that because our normal business is pretty quick here.
Pretty brief.
So,
okay, well let's get Craig started first, and then you can kick her off.
Yeah,
sounds good.
Give me a sec.
And then Paul will be madly struggling to get us broadcasting live on YouTube while we're going through these details. Oh, I see him.
Yep.
But he can't say anything because he's not on stage, so I'm going to assume that it's working.
But it's okay. Yeah, it's recording.
Okay.
Away, K-Mets.
All right. Well, welcome everybody. Today is May 18th, 2023 for the weekly Aladdin community call. Today we will be going over a variety of topics, and we'll start off with Clever. Harvest round 44 completed this week. Kind of on par with a lot of the rounds we've had lately, and not a big jump up or down or anything. I think we're still doing a few percentage points better than what we were doing, a few months ago, just because of the new algorithm. But kind of all systems nominal there.
Yeah, the best news from a system like this is the boring news. It continues to work as advertised.
Yeah, exactly. It's one of the best things you can hope for out of some sort of an engineered product. So
that's right. Exactly. Especially when you've got money inside that engineered product, you want it to be.
Boy, no joke, right? Yeah. Well, all right then. That's all I have for Clever. And for Concentrator, we've enacted we basically doubled the harvest bounty from 1% to 2%. And so people should start seeing more frequent harvests for their vaults. So that's ongoing.
Yeah, basically, this is something we talked about last week. Basically, the since we switched over to the new harvesting system that allowed us to zero out all the withdrawal fees, we haven't seen the harvest happening quite as regularly as before. It seems like there were more sort of drive-by harvests happening, even when it wasn't always like economically viable, when people weren't always profiting. They were still choosing to harvest sometimes. And now, and of course, when one person chooses to harvest, everybody benefits. That's not happening anymore because we've restricted who's allowed to harvest these vaults, right? And there's now this requirement that you have to hold 2,500 CTR. And just, as a reminder, that was put in place specifically so that we could zero the withdrawal fees, right? Like there is a specific type of abuse that a harvest system like that can have, where players can come to the vault and basically harvest everybody else's earned yields with their money and take off, right? So that was the reason initially for the withdrawal fee. With no withdrawal fee, we need an alternative system, and that's this sort of like semi-permissioned harvesting. But the frequency of harvesting has dropped. So what we've done is we've tweaked up that bounty a little bit. It makes a like a 1% difference on the overall fee. It's pretty small. Shouldn't be particularly noticeable, but except should help to get those harvesters harvesting a little bit more frequently than before.
Yeah, I think it's overall positive sort of quality of life experience for everybody. So
yeah, exactly.
Those happen more often. And then
and we're gonna keep an eye on it as always. Like we're always kind of watching how the system goes and listening to what people have to say when they come over to the Discord. And if you've got you can ask in the Discord always and find out sort of more details about when a vault was harvested and get that kind of information. But sound like a broken record here, but generally speaking, these vaults are made for sort of long-term set and forget kind of stuff, right? Like lower TVL vaults harvest less frequently. Even with the increased bounty, it's not going to make a really low TVL vault harvest really frequently. But over the long run, it all sorts out.
Yeah, absolutely. Yeah, you got to have it's best to I always kind of look at them like a savings account. That's kind of probably the best way to look at it. So.
Mm-hmm. Yeah, something you're trying to hold on for a while.
Yeah, exactly. And then we've got a couple of new harvesters you guys have probably seen. And it looks like the new harvesters kind of pop up to the top of they kind of float to the top of the harvest list now when you upload the UI. So that's cool. And they are...
Yeah, check. Sorry, go ahead.
ETH, WB ETH, the new Binance product, and then UZD Frax base pool, the Uzami, is that how you say it? Uzami, their Frax base pool product. So those are brand new.
Two brand new harvesters and both pretty amazing looking APRs. Right now, the WB ETH has come down to earth since I first tweeted about it late last night. But we've already got concentrator based, like we've already had some deposits through concentrator there, and it is still over 20% on an ETH and ETH LSD staking vault. So the yields are still very good, and I have a feeling, it seems to me like Binance, from my perspective, at least from like an outsider's perspective, they look like they're pretty serious about getting into the curve wars. They've gone to the trouble to get their gauge, and they are actively bribing, which is interesting because I don't know that we've seen like a big centralized entity do that before, right? Like Coinbase certainly never has.
Coinbase hasn't. Well, I mean, you can tell they're serious because they had the masters of the Curve ecosystem on yesterday to talk about it.
That's true. But I mean,
gosh.
it's also a put your money where your mouth is situation, right? Like Binance is paying real bribes here. It's kind of a big step, right? It's like a big change. Anyway, point that I was trying to make is that that concentrator vault's a great place to sort of relax for a while if you want to just benefit from this new entrant, this new sort of approach. And hard to know what Binance is going to do in the future, right? How they're going to play their bribing game, but certainly they've got the resources if they want to make this pool very, very competitive and to really help boost on-chain liquidity for their LSD. So be interested to watch how that evolves.
Yep, absolutely. And then I guess just kind of moving on, we'll just quickly, Aladdin, all systems are nominal with kind of the Aladdin DAO. And
yeah, and I mean, obviously, all of our effort right now is in all of Aladdin's effort. I mean, is being put into F of X protocol, right?
Yep.
Obviously, and I think that's our main event for today. We're gonna jump into that, and we've got some slides to work through to just kind of deep dive into the corners a little bit and try to just we're always working, on the contributor side especially. We're always working on sort of our language and our communication essentially. How do we communicate what this thing does and how it works? And what the value prop is and why people might want to use it. And so we're going to be trying out some new stuff on you guys today, trying out some new diagrams and ways of thinking about it. But Aladdin in general, we're totally focused right now. Apart from obviously the running of of Clever and Concentrator, the day-to-day stuff, all of our main energy right now is being put towards F of X. And maybe Charlene can give us an update about where we're at on the technical side for F of X later. But as for the actual sort of education mechanism and telling people how it works, that's what we're going to dive into today.
Yeah, Paul, or how's it looking on your end?
Yeah, I don't think it's gonna work. So everyone who's not with us on Discord will have to access the YouTube link in order to watch the stream.
Okay. Well, at least we've got the stream up and running, and it'll be recorded too, eh?
Yeah.
Love it. All right. Let me see if I can share my screen in a way that doesn't completely dox me. Do you think I can do it? I am not sure. Let's see.
My money is on you. It wouldn't be on me.
All right, here we go. Let's give it a shot. All right, how are we looking?
We just lost.
Just lost it? Okay, so hold on. How about now?
Still not available.
Okay, stand by. I full screened it, and I think that was my mistake. So let's go live just on the windowed screen. Better?
We can see that.
Okay. We can step through it just kind of in the in this mode if you want, or actually I suppose the other possibility, just bear with me a sec, folks. Let's go. Slide show. Oh. I think I might have got it here. Let's see. Share your screen. How's that look? A little better?
That looks pretty great.
All right, let's do it. Okay, so we're gonna talk about F of X, and we've got some different ways of digging into it here. But basically, this protocol or this deck that we put together is kind of like, it's meant to be like a from the start intro. All right. So if anybody who kind of understands the what's going on with the protocol would please bear with us a little bit, and any feedback that that you have at the end for how we can do better and communicate more clearly would be very appreciated. But anyway, this is F of X protocol. So the story for F of X is that we are dividing ETH up into two sort of components, right? Into a high volatility XETH component and a low volatility FETH component, right? And so you can kind of just visualize that as taking ETH and dividing it into these two chunks. And if you were to combine the two chunks back together, you get ETH again, right? They are complementary. So F of X creates these two derivatives, these ETH derivatives. They're called X, ETH, and FETH, right? So FETH, we sometimes call it as a floating stablecoin. It's not pegged to a dollar, but its value changes at about 1/10, well, exactly 1/10 the rate of the value of ETH. So if the price of ETH goes up by 10%, the price of FETH goes up just by 1%. Likewise for a fall. If ETH drops 10%, then the value of ETH drops by only 1%. The flip side of FETH is the XETH token. And the XETH token is basically the token that is absorbing all the volatility that is not going into FETH. And what that means is that it acts pretty much like a leveraged long perpetual. It has a leverage that varies. We say 1 to 4x, although it can go higher if the system becomes sort of like pushes towards into stability mode. It can go above 4. But during normal operation mode, the leverage will vary between 1 and 4. And we'll talk more about how that changes in a bit. But the key point here is that that XETH price moves at greater than or equal to, but typically greater than the rate of the price of ETH. But it has zero funding costs. Normally, if you have a leveraged long perpetual token, you've got to pay funding costs. And that's not the case with XETH. It's just a token that moves in that way. Okay. Anything you want to comment on before I move on, K-Mets?
I think we'll get into it here in a minute, but I think especially with FETH, we call it a floating stablecoin. This is something we've had a lot of like really philosophical discussions about that, and that's a term to kind of like get people sort of in the ballpark of what this is. Ultimately, it's a low volatility asset. That's
exactly. But and low volatility asset just doesn't quite roll off the tongue, does it? So the other thing is that we're going to get into it second here, but the other thing is that the FETH is really used where you would use a stablecoin. It's not itself a stablecoin, but it kind of. So we'll move on here.
Yeah.
So FETH is not a stablecoin, but I do play one in DeFi. That's a classic North American commercial throwback for you guys there.
Oh gosh.
And I definitely meant to delete the header FETH a Steady Lads coin. So I'm going to go ahead and modify that for the next run through of this deck.
Yeah. So we'll just go ahead and just say every FETH is backed by ETH.
That's right. Yeah, exactly. Yeah. The Do Kwon references, delicious though they are also, possibly misleading. We don't want to give people the wrong idea. Anyway, so FETH is what can you do with FETH? It's about planning future expenses when your expenses come in sort of like fiat terms. And that means like for a DAO, you want to part of what you're paying your contributors is probably stable coins because your contributors have real world like fiat expenses. A stable coin like an FETH can be used to trade in and out of crypto on chain, the same as a stable coin can. It can be used as money at rest, right? The same as a stable coin can. Basically anywhere that you use stable coins, but you also value these three key new like aspects that FETH brings, right? I say new, but there maybe the combination of them is new. Decentralization, like actual decentralization. There are decentralized stable coins. And FETH is at least as decentralized as they are. Scalability and liquidity, right? Quite often you get one or the other, decentralization or scalability. This is really like the unicorn that the stablecoin world is hunting for is something that is decentralized and scalable with deep liquidity. And so FETH can provide that. Like the system is able to harness the demand for leveraged longs in order to be able to provide a very deep liquidity on FETH. And the last point is like a long-term fiat inflation hedging, and this is the story about 10% of ETH's price movements, right? As people who've been following us know, we've talked about how the system really could be used to make a pegged USD stablecoin, but we've sort of made the decision to, rather than zeroing the volatility, to just limit the volatility, allow for a little bit of volatility to leak through to FETH. And one way to think about that is as a bit of an inflation hedge. You remain slightly exposed to the crypto market on the assumption that long term that fiat is going to inflate or devalue versus crypto. If you have that kind of thesis, as a lot of people in this world do, and as we tend to have, then you don't necessarily want to give up all of your exposure. So there's some philosophy built into that. There are, and we can talk about the details later, but that's kind of like the big picture of FETH. That's what FETH is bringing to the table.
Yeah, no, that's perfect.
Okay, so XETH is the flip side. All right, on the XETH side, you're talking about even though it's complementary to FETH, it is in fact almost targeted. It's targeted at almost the opposite purpose, right? Which is a levered long perpetual. So XETH is this composable, like this tokenized, composable, all that fun DeFi stuff, on chain, leverage long ETH perp token. But it has, and again, I mentioned this before, I mentioned it again because it's a big deal, no funding costs, a low chance of total liquidation. So when you hold XETH, basically you are exposed to that multiple of the price movement of ETH. But if the value of your XETH were to ever fall to zero, that would indicate that the overall system would lose its ability to hold that 0.1 beta peg for FETH, to keep that volatility limited for FETH. So we're going to talk about more later. The system has a whole bunch of measures that it is able to deploy in order to prevent that situation. And so the whole system is kind of like built to prevent your XETH from getting totally liquidated, which is kind of a nice way to think about it. It's also as I mentioned before, between 1 and 4 times effective leverage. So basically the price of XETH is going to move sort of in this normal operating mode up to 4 times the magnitude of the ETH price, up and down, right? And then, and it's leverage. The leverage that XETH actually its effective leverage varies with the ratio of the 2 tokens minted, and we'll get into that more later. Okay, so big picture, this is how it works. FETH holders increase leverage for XETH, and XETH holders shield FETH from volatility. This is that classic, DeFi two-sided market, as you like. Okay, so there's your elevator pitch for what these tokens are and why you might want them. So let's now dive a little deeper and start talking about how does a protocol actually behave, how does it create them? And we'll talk first about what we call the F of X invariant, okay? And that is that the total market cap of all FETH plus the total market cap of all XETH is always equal to the total ETH collateral value in the protocol, right? We're going to talk about it. Minting and redeeming XETH and FETH is always done through pure ETH, and that ETH is held in reserve by the protocol. And so we make sure that the ETH that the protocol holds, that the obligations, the FETH and the XETH, the total value of those obligations is equal to the total value of the reserve. So what happens when the ETH price changes? So this is where what I'm calling here a volatility partition, which is probably unnecessarily complex language. When ETH price changes, the FETH price moves a little and the XETH price moves a lot. And Kmet's put together this great diagram here, and he's tweeted it out on the A-Team account. People have seen this floating around. We've got some more variations here to show you, but basically what happens is if you have 200 of ETH in the reserve, and let's say your XETH and FETH are evenly split, there's 100 of each in the world. If that ETH moves up by 10%, you get a 10% jump in the price of ETH. Suddenly you have $220 worth of ETH in the reserve, right? And so that extra $20 is divided between the XETH and the FETH. And so the XETH gets most of the volatility, right? So XETH jumps by 19% and FETH by only 1%. Okay. Now we're gonna jump into that same example, but just kind of highlight what we are talking about when we say net asset value. So the net asset value is tracked by the protocol. It's calculated by F of X, and it is just simply the current value of 1 XETH or 1 FETH, and they each have their own NAV that is tracked by the protocol. and that the NAV for FETH and XETH is continuously updated, right? Based on, as the price of ETH is continuously updated to constrain volatility of FETH while simultaneously satisfying the invariant that we talked about before. So basically, the price goes up. We make sure that the price of FETH goes up by just 10% of that, and then all the rest of the volatility movement is focused in on the XETH. So to give you a picture of the previous example that we just talked about, if you think about the NAV of each of these tokens, if it started at $1, then the NAV of FETH is now going to increase to $1.01, and the NAV of XETH to $1.19. So as you can see here, just what we say, the total XETH value of the whole protocol goes up by 19%, and the way that that's tracked is by the NAV, and the NAV goes up by 19%. The supply remains the same. Okay, same number of XETH in the world, but now each XETH is worth, an extra 19 cents. Okay, so before we get into even more detailed, I see that Tao, did you want to jump up on stage? Did you have a question, or do you want to maybe wait until till after? Do you want to? It's up to you. If you drop a message in text if you have a question, and I'll pull you up if you want to chat about it. But I'll just maybe soldier on here while you're thinking about that. Okay, Tao's typing. We're going to keep going, and we'll jump back. Okay, Tao's going to do later. Very good. Okay, moving on. So that's the net asset value, and that's how it changes. We're going to continue to develop this example a little bit to talk a little, sort of highlight a little bit more how it goes. So users can mint and redeem XETH and FETH at any time. Sorry, they redeem XETH and FETH for the current NAV, and the NAV does not change when that happens. So continuing to work our example, we say we're going to deposit sort of, I think that means 2,000. Oh, so we're going to start with $2,000 of reserve. Actually, sorry. K-Mets, why don't you speak to this? This is your diagram. I don't want to jump in.
Okay, yeah. So we basically, in this diagram here, we're going to deposit some ETH into f of x protocol, which is the square, and we're going to mint some FETH. And so essentially what we have in our system right now is we have $2,000 of reserve ETH. If the price of ETH is $2,000, it's 1 ETH. And then we have $1,000 worth of XETH and $1,000 of FETH. And we have 1,000 tokens of each of those. So we're going to pretend this is Genesis. We've seeded the liquidity pools. These are the prices at NAV. And I'm going to be the first user. I'm going to put $200 of ETH into it. And I'm going to mint my FETH tokens. And so because our NAV is $1 of FETH, I get 200 FETH tokens out. Now this increases our reserve ETH because we put in $200. And so that's 10% of 1/10 of an ETH. And so you get 1.1 ETH in the reserve now. And our XETH stays the same. We haven't changed anything. We haven't minted any XETH coins, and so the NAV of that stays the same as well. And so we now have $1,200 worth of FETH, and 1,200 FETH tokens are now in the system, out in the world, doing whatever. That's pretty much the basics of it. And so as you can see, FETH has grown in relation to XETH, and so the leverage of XETH has actually increased in the system because of that.
Yeah, and we'll get into that the details there, but I think for now the main thing on this example is to show that the NAV has not changed. We've deposited $200 into the reserve. That's given us $200 worth of FETH back out, but each token is still worth a single dollar. That does not change. Remembering in the previous example, the NAV did change because the price of ETH changed. So this is kind of a key thing to understand. Minting and redeeming doesn't change the value of everybody else's XETH and FETH. It just changes the total supply. All right. Let's keep going, because this example gets even more spicy.
Yeah.
And I'm gonna leave this to you. Go.
So it gets more spicy because as we're going to do a redemption example of FETH back into our ETH tokens, and it gets more spicy because the price of ETH, we're going to pretend it's increased to $2,200. It's gone up by 10%. And so what happens then is the NAV changes because the underlying price of ETH changes, and so that price affects FETH, and so our FETH is going to respond at 10% of the rate at which ETH's price changes. So that means if ETH went up 10%, FETH is going to go up. Its NAV is going to go up 1%. So they were $1 before. Now they're worth $1.01. And so we have 200 FETH tokens, and we're going to redeem them at $1.01 each. And so on the left side of the screen, you can see that we've taken out $202 worth of ETH, because 200 times $1.01, that gets you $202 worth of ETH, and that changes the reserve amount of ETH, because we've now taken out $200 worth of ETH. That one ETH is worth $2,200. So you actually now have 1.01 ETH in the reserve. So it's a lot of math. There's a lot involved there, but essentially what the point of this is like when you mint and you redeem, you're redeeming at the NAV value. It doesn't change based on the number of tokens in the system. It's based on the price of ETH changing up or down.
Exactly.
And for XETH, that its NAV changes based on the ratio that it has with FETH and the reserve ETH. So all the equations are in the white paper, and when you're interacting with the system, it's going to do all the work for you in terms of calculations and letting you know, and you'll be able to access it anytime through the UI. But the importance of this is that everyone kind of understand, like, okay, well, it's all about, I can redeem this at the NAV value and I get my ETH back out, and this is sort of how the system functions.
Exactly. And this is, and Admiral gets it. He's in chat. And I think that the risk here about really stepping through all of these, details in a really kind of pedantic way is to make it sound like the system is more complex to use than it is. I think that the way that, helping people understand how the price of these tokens change is kind of important for when you're understanding what they do. But in the end, you're going to go to the FFX website and you're going to see an NAV for FETH and you're going to see an NAV for XETH. And that's its price. You want to mint some, that's how much you pay to mint it. You have some you want to redeem, that's how much you get back for redemption. Like it's really quite straightforward from a usage perspective. But understanding how these things change, and it's also good to get a handle on what other participants can do in the system that could affect what you have, right? And that's one of the reasons why this business of talking about sorry, lost my train of thought. That's one of the reasons why we're kind of beating on this stuff so much, is that you want to understand what other people can do, and if somebody else could come in and change the NAV of tokens you already hold, like basically change the value of tokens you hold by minting or redeeming, that's a bad scene, right? You don't want other users to be able to have that kind of direct control over the value of what you hold. And so it's really important to understand that that NAV doesn't change, just the effective leverage of XETH.
Yep.
All right. So now I put in, so I've got a couple of just kind of plot examples here. These are a little bit barfy, but hopefully you get the idea of how these things behave. So I grabbed the daily price. And by the way, this is like, please don't like overanalyze these plots. There's a few assumptions and like simplifications made here, but I just wanted to kind of show how the value of how the NAV changes and what the reserve backing looks like as the price varies of ETH. So we'll start with our good times example, which is we looked at the first couple of months of this year when we were starting into what you call the relief rally or whatever. And the blue line here indicates the price of ETH. And starting from January 1st, and it's plotted as a daily percent change. And you can see that the price of ETH, rose up. It rose by 25% over those first sort of couple of weeks and then wobbled around in here. The simulated price, now again, this assumes no minting and redeeming. It assumes equal numbers of FETH and XETH with no changes to those. So this is like an unrealistic, simplified situation. But watch that yellow line. When all of those other things are held steady, you can see that the return on the XETH is a multiple, right? It's just around 2. It's a little less than 2 times the return, both up and down. You see these drops, the magnitude of the drops are larger here than there. And you can see here that that the price movements of ETH, they're reflected in a very, very tiny way down here on the FETH price, but mostly that's stable. That's stable enough you can plan for expenses with. Whereas on the XETH side, you can see it absorbs all that extra price movement and you get that amplified movement. And then up in this top right here, I just show the reserve. And you can see how the reserve, the FETH reserve stays pretty flat, right? Like this is equivalent to looking at the price. The ETH backing FETH stays pretty flat, or the dollar value of ETH backing FETH stays flat, whereas the dollar value of ETH backing the XETH is kind of all over the place. It's up and it's down, and that's sort of like that's how that breaks down. So let's jump now into part of this slide didn't load. Dang it. Show anyway. Okay. I am going to. Sorry, folks. I'm not sure why that's not loading correctly. Let's take a quick break. This is what it's supposed to look like. I'm not sure why it doesn't. Oh, do you still have my stream up? Yes, you do.
Yeah,
okay.
Yeah, we still see it.
Let's just look here for now, and then I'll jump back into the slideshow in a sec. Here's the NAV in bad times, and this is what I picked from January 1st to May 15th, 2022. Now, again, and I'm going to go back and highlight the caveats here. Zero minting and redemption is not realistic, and it's especially not realistic in the bear scenario, because when the total amount of reserve backing the XETH falls down, like when the total fraction of FETH versus when the fraction of FETH versus the total ETH reserve gets really, really high and that red bar gets really, really small, the smaller that red bar gets, the more incentives and stability, like stabilizing mechanisms that the protocol brings online, right?
Yeah.
So when I simulate these prices, it ignores all of those kind of like behavior changes that the protocol's stability mode would create.
So this basically what you're showing is without any guardrails, without any of the risk modules enacted. This is just sort of raw data and just
and an unrealistic simulation, right? Because people are going to be like, even without the stability mode of the protocol, people are going to be minting and redeeming FETH and XETH kind of like based on their own needs all the time. And after a price drop, you know, you're going to have some subsection of people who are probably looking to buy cheap XETH in order to like ride the next little pump or whatever. Like it's a trading product. So it's really difficult to say. But again, just purely using this as a how does the price react in a sort of spherical cow in a vacuum situation, you have this this performance where it looks much like our last example, except you know, in the down direction. You see big price drops on XETH where you only see smaller one, where you like smaller. Big price drops on ETH make huge price drops on XETH, and small wiggles in the FETH NAV. And you can see here that the FETH NAV through this period of time remains approximately flat. You're losing a few percent here or there, which is the price that you pay in order to gain a few percent on the upside. But you can tell right away here when you look at the backing plot, like the reserve plot, that the reserve backing XETH is varying quite dramatically, right? And that's as expected. That's why you see these big changes in the XETH NAV.
Yeah, it'll be interesting to see sort of how it functions in the wild with sort of all the stability mode risk modules engaged, because there's a lot of incentives that are sticking carrots that are enacted to
That's right.
to really incentivize XETH holders to either mint XETH or hang on to it, and it'll be interesting to see sort of, and we're still working on the mechanics of it, but the design of the system is to keep a safe amount of XETH in the system. So as you can imagine,
That's right.
like on the downside, it will be well incentivized.
So, and now let's jump ahead again, our inexplicably undisplaying slide here. Let's keep going, and we're going to talk about that XETH effective leverage. So here's a plot, and we've mentioned this before, that the amount of leverage that XETH gets is dependent on the fraction of the FETH versus the total supply. So there's a lot of different ways you can come at this number. Later on, we're going to talk about the collateralization ratio, which is like the total supply divided by the FETH supply. But it all, ultimately it all works out to the same thing because of the f of x invariant, right? Like you've got a fraction of your ETH is backing the f of ETH, and the rest is backing XETH at all times, and it always kind of the protocol forces that to always be true. And I see that I've got my old plot here. These spots are not in quite the right locations here, these points. I didn't update this. But anyway, the general shape is correct. The stability mode actually kicks in at a leverage of about 4. So it actually kicks in about here. I will have to correct that. But in general, the effective leverage of XETH is increased whenever FETH is minted or XETH is redeemed, right? So that's that fractional FETH supply, right? If you make more FETH, then the fraction of FETH is higher. If you make less XETH, then again, the fraction of FETH is higher, and it pushes the leverage upwards. Conversely, if you mint new XETH, you dilute the other XETH, right? The leverage of the other XETH. So it pushes you down here. And this is the same for redeeming. Removing FETH from the system is the equivalent to redeeming XETH, in that it pushes you down this curve towards a lower leverage. And ultimately, you can see we can't allow the system to run away up here. And so as we start to creep up this curve, we engage these new protocol. The risk management module has these new features that it engages. And we're going to talk about exactly what they do coming up in a sec. But let's talk just briefly about this idea of collateralization ratio. This is just another way of looking at exactly the same thing, really just kind of trying to come at this description from a bunch of different directions, right? So the price volatility of the total reserve is focused onto the XETH token. And what does that mean? So it means we need enough XETH to absorb those price movements without XETH going to zero. Because if XETH goes to zero, then we lose the ability to constrain the beta of the FETH, and suddenly the beta of FETH will go with ETH. And so your FETH is always redeemable, but it's now going to move if we ever got into this, like what we call a destabilizing event. So the protocol does everything that it can to make sure that doesn't happen. And we use the collateralization ratio just for the purpose of describing these thresholds that we've created for how we engage the stability mode. And the collateralization ratio, like I said before, total reserve divided by the FETH reserve. So it always wants to be over 100, right? There always needs to be XETH in the system. And you can get a sense that the stability of the protocol kind of varies as this collateralization ratio, right? So here I've shown a collateralization ratio where there's plenty of XETH and a safe overall system CR. And if the XETH really drops a long way down, getting closer to 100, now the system becomes a little bit more vulnerable to a dramatic price movement. That's the risk. If there's not a lot of XETH and you get a huge drop over the course of a single day or a single period or whatever, before the sort of like incentives have time to react, that's when there is this destabilization risk. So that's what we're monitoring, and that's what we're setting all these thresholds at. Okay, next up, we're going to talk about those risk management modes and how they work. So we have 4 progressively more powerful modes, and each one of them, has, well, it's what it says on the tin, right? As we go up through the modes, we add sort of new measures in order to incentivize a push back down that scale. And these measures, as I'm going to get into, especially in user rebalance mode, they are straight up MEV-able, like profitable arbitrages. And so this is a very powerful way to ensure system stability. We have set the thresholds using this value at risk calculation. And so we took the historical daily price changes for ETH, and we basically said, if the collateralization ratio gets sort of low enough that the odds of a probability, like the probability of a destabilizing event is more than 0.1%, then we turn on stability mode, right? And that happens at about 130%. If we were to ever fall down to 120%, that would make the probability of a destabilizing event 0.25%. And so that's when we turn on user rebalance mode. And user rebalance mode, as I'll get into in a sec, is the mode where the where you have this like on-chain arbitrage, like profitable arbitrage that restabilizes the system. So it's very powerful, and and I would expect that's the only one we would ever see in practice. Again, hard to predict, exactly what happens with ETH over short periods of time, but protocol rebalance mode is just an extension of that, and we'll get into that in a sec here. So starting with stability mode. Soon as we get to this point, and like I said, I apologize, I screwed up this plot. This dot should be up here at about a leverage of 4x, but the stability mode kicks in at this point, 4x, and first thing we do is disable FETH minting. So you can't come and mint new FETH at the protocol at that time, right? Redeeming FETH, the fee is zeroed out. Under normal circumstances, we would have like a small fee for minting and redeeming. That's how the protocol makes money, is by charging these sort of small nominal fees on minting and redemption. Those redemption fees for FETH go to 0 as soon as we start to get into that 4x leverage range. Redeeming XETH will then have a slightly bumped up fee, and minting XETH will actually earn you a small bonus here. So this is kind of the big one. I've saved it to last. The big incentive here is that if you want to mint XETH, you can actually get a little bit more ETH worth of XETH than what you put in. Now, of course, you can't immediately arb that back out because the redemption fee is also increased, right? Because otherwise people could just come in and take that away and it would do no good. But once you get into that stability mode, you basically get extra leverage on your leverage. You get extra XETH for the ETH that you bring into the protocol. So that's kind of like the gentlest mode that we have once we get to that point of leverage. If the leverage of the system continues to edge up, the leverage and the leverage of XETH continues to edge up with it, we enter this what we call user rebalance mode. So FETH and minting is still disabled. All the non-bold text here is the same as before, right? We still have all of the same measures in place, but now FETH redemption earns a bonus. And this is where you have that arbitrage, right? Where you can buy FETH on the market and you can redeem it for more ETH than its NAV. And so this is a very powerful way of being able to have like MEV or arbitrageurs to be able to come in and basically take a profit in order to recapitalize, or not recapitalize, in order to increase the capitalization of the overall protocol. And then the last risk management module is called protocol rebalance mode, and it's exactly the same as user rebalance mode, except that the protocol itself, as in f of x, can actually use the ETH reserve to perform that rebalance. In the end, this is the equivalent to a user rebalance, except that the fee difference is actually earned by the protocol in this situation. But what happens here is that the protocol will take some of the ETH that's backing FETH buy some FETH on the market with it, and then burn that, so that the total NAV of FETH doesn't change. It only changes by the amount of the stability fee that was sort of like the bonus that was paid in order to do that operation. So protocol rebalance mode is one of those things where, you know, it only kicks in if nobody wants free money in user rebalance mode. However, we wanted to make sure like that it is clearly there. There's like an end of the world scenario that's described in the white paper where we'll that we call like a recapitalization mode, where, you know, if something happened and we went even beyond that, then we allow a flexibility within the protocol to raise some ETH to recapitalize, to like bring that capitalization level, bring that collateralization level back up where it needs to be. So that's it. That's risk management. I mean, we spend quite a lot of time talking about that because I think it's pretty important. But ultimately, we've got these, you know, synapses here. We've got these three modes that add progressively more juice to this push away from overweight on FETH and towards and you know, we've had lots of discussions and we're still looking to talk with people in the community. A lot of feedback I've heard is that, you know, people are pretty confident that the demand for XETH is always going to, like, there's always going to be some kind of demand for XETH, because there's just, you know, in the white paper we spent some time talking about, like, we looked at the open interest and the funding rate as this proxy for demand for like long ETH positions, and in every market condition, like in the chaos of 3AC and Terra and everything, like there's always some level of demand there. So that's something that we look at. That's something that we look at. Sorry, go ahead, K-Mans.
No, I was just going to say, I mean, the entire point of the risk module systems is to start to basically limit the downside of XETH, you know, and so you're still incentivized to hold it for the gains that you'll get, and the leverage increases as well, you know, as the collateral ratio is decreasing. So you know, in every bear market there's these huge bounces. So I mean, you know, traders are gonna hold it and use it for whatever they want, but you know, it's up to us to just make sure that the system always has an amount of XETH in it that's going to be tolerable and safe. So that's the whole design of all of this. So
and exactly, and it's like, you know, this is a component of the DeFi ecosystem as well. Good to keep in mind that, you know, your like FETH is FETH is like not your only stable option, right? And so you may choose to divide between FETH and other things. I mean, the point that I'm making here is that the system can sort of gracefully expand and contract through these incentives, right? And keep in mind, and the reason that I mentioned things like other like pegged stables, for example, is if you check out here we go, FETH redemption 0 fee. Check out the user rebalance mode. FETH redemption earns bonus. Your FETH you can withdraw FETH for more ETH than it's currently worth. So even if you're in the protocol, you can arbitrage from your FETH to a pegged asset, to a pegged stablecoin, and earn free money. Just on, and that again is part of the story. There's this arbitrage, you can market buy it, but then all the holders of FETH have this equivalent arbitrage opportunity if they want to scale up their stable holdings, right? By giving up their exposure to ETH, maybe just temporarily during this, like a period of extreme volatility or whatever. There's another arbitrage to be had, and of course, the protocol sort of flexibly expands to accommodate all of those changes, right? It makes it a little bit, we just need to make it a little bit more attractive to perform actions that push the protocol towards being more stable versus less.
Yeah, I mean, the whole thing is to basically make it sort of a no-brainer decision. Like, well, I'm definitely going to redeem some FETH, and, you know, I'm definitely going to hang on to my XETH. So it's sort of aimed at doing that.
Yeah, exactly. All right. Oh, I see Mr. Masas joined us on stage. Hello, welcome.
Feel free to
Oh,
unmute.
okay. Speaking now. Okay, great. Yeah, thank you. So we have lots of arbitrage opportunity with this synthetic assets. This is great. Then, but especially I want a more deep understanding about when Ethereum is in a bear cycle, then we want to motivate some investor to hold the XETH token in this the FX protocol. Then, what kind of arbitrage strategy for XETH holder can take when in a ETH bear cycle? How they gonna make money by holding an XETH token in a bear cycle?
Well, so let's see here.
Well, and you also have to remember these are composable assets. So I mean, someone can build products on top of them as well. So
yeah, and that's a good point. But I think let me address it this way, Mr. Masa. If you know 100% that ETH is going down again tomorrow, you can make a lot of money. You can't do it holding XETH, but if you can predict the future perfectly, you can make a lot of money. And yeah, in that case, if you know the future, you should definitely not hold your XETH on that day that you know it's going to drop. But I think that the key here is like and this is part of the reason why we did so much digging on the demand side. Obviously, like before we started talking to the community, my concern was very, very much around demand for XETH, right? Like we need enough XETH in order to protect the FETH supply. In my mind, like because I guess I'm too conservative of a guy, in my mind, everybody's scrambling for FETH, right? And everybody's dumping XETH if their sentiment turns. But as we look into the numbers of, and that's why I mentioned the numbers of the open interest and the funding rate, funding rate almost never goes negative. And
yes, I know. Yeah.
Which is kind of as you know, and it's remarkable. And so how if you know that the price of ETH is dropping tomorrow and you have perfect future knowledge, then you are going to sell your XETH, and there's no way that you use your XETH to make money in that case. But if you're trading on a bounce or whatever, this is less about an individual trader and more about across all the spectrum of users. Is there somebody who's looking to buy that at any given time, right? That's the question. And K-Mets also brings up a really good point that like the composability of this allows you to use it maybe to use it maybe as a hedge as a hedge against a short position that you hold, for example.
Right.
So there's some options like that, but your point is very well made that having that XETH in there to protect the FETH is a critical aspect of the system. One of the things I'll talk about, and maybe I'll let maybe Charlene sort of clarify this a little bit, is that ultimately the protocol, like the FETH token in this sort of like, what if the worst happens, the FETH token is still very much backed. The ETH in the reserve isn't going anywhere. What we lose the ability to do is to constrain the volatility, right?
Right.
And so, you could argue that is itself as far as failure modes go on the FETH side, that's a pretty attractive failure mode, right? Like your FETH has just turned into ETH. So there's a few sort of aspects to sort of consider in all of that, but no, I like I say, your point is well made that definitely in every cycle we need to be able to maintain enough XETH interest to be able to do that. But the stability mode, the different stability modes in the risk management module will provide, there will be some incentive for people who are in the system to self arbitrage, basically exit their FETH position into, a different, say a really nice decentralized USD pegged stablecoin that you like. You can earn get more than your FETH's worth of ETH, which you could swap immediately into a different as a decentralized stablecoin. So there will be a certain amount of people who will, in the negative cycle, who will exit FETH positions, even in the negative cycle. Like that is a profitable option for people inside the system. So I don't know if I've done a very good job of answering your direct concern here, but there's a lot of moving pieces here, and it's, for us, it's something that we're really going to be keeping a close eye on user behavior, really try to get the parameters just right to sort of be able to respond and to really understand how users respond to these different incentives. You know, we use this value at risk calculation I described in order to have thoughtful thresholds where we start to change the behavior of the protocol. But ultimately, it's really going to be about how the users feel and how they behave in these different situations.
I see. Yeah. Then
maybe I can
go
add
ahead.
some
Yes.
color to this. Yeah. So maybe I can add some color to this to Kruger's answer. So Perpetual is a massive market, right? Just like today, I don't know, this is a bull market or bear market, and I don't know if it's going up or down tomorrow, right? And any single day, I look at crypto Twitter, right? We always see, right? People tell us, right, their view, they have completely different view on where ETH is going to head, right, in near term. And so just like a day like today, there is 1.7 billion ETH perpetual open interest on Binance only, right? And perpetual is a bilateral market, right? So you need both long and short to open position, right? And so there has, as Kruger said, there always been demand for long perpetual on ETH. Otherwise, the open interest should just go down to zero. And also, if you look at the funding rates historically on ETH perpetual, right, it has been like positive most of the time, right? When funding rate is positive, that's most likely, right? There's more long interest than short interest on ETH. And I think, what makes XETH really attractive compared to holding perpetual on, traditional centralized exchange or decentralized exchange is it has no zero funding cost, right? And has extremely low risk of liquidation, right? And perpetual is known for being very risky and expensive for traders, especially retail traders, right? But at FX, right, it actually it's an ideal product for people who want to get that long-term exposure to ETH, right? Because I think most people in crypto have a pretty bullish view on ETH over the long term.
Yeah. I basically agree with the Sharin's and Kruger's the thought about this point. Then I try to bring additional strategy to make sure our hypothetical scenario is accurate to work here. So I totally agree with that. In long term, I think the perpetual market, longer position, long position, Ethereum market is straight, never goes to negative, but simply because deflationary tokenomic effects on Ethereum is quite powerful weapons to attract those kind of long position in a perpetual market, because they can already achieve like minus 2% supply annual basis. That's pretty good. But all the time in crypto market, we have to suppose like some kind of extreme things would happen here. The Luna crash is kind of a good example. Then that's one of the reasons I try to bring here as an additional strategy is like kind of concept of protocol own liquidity, like Currency is doing so. So the point is if you can attract not a speculator, more like a passive investor who can continuously make money with their holding the ETH token long term, that's we can control their liquidity inside this FX protocol, especially like liquidity balance between FETH and XETH. That's what I'm thinking about. So for example, like as I mentioned in my memo that FX protocol also works like, POS validator on Ethereum. So we can continuously, earn the ETH tokens as a POS validator. Then additionally, those massive ETH reserve on FX protocol, they are the passive investor. So we can use these reserve to adjust our balance between XETH and FETH. So the point is, in this, FX protocol model, even, Ethereum going to the bear cycle, the XETH, those kind of volatility loss is still unrealized one, in my understanding, because it's just control the balance sheet between XETH and FE. So those long-term investor, that they're gonna put their ETH into the FX protocol through the concentrator to something, then they can continuously hold this ETH token, like let's say next 10 years or so. Those liquidity, those ETH reserve help us a lot to control or adjust our supply and demand balance between XETH and FETH, even Ethereum goes to the bear cycle. What do you think about this kind of idea? Then we're gonna kind of make them like minimize the minimize of speculators actions in this FX protocol on a liquidity pool. What do you think?
Charlene, you want to jump in or?
So I
Sorry, go ahead.
understand Mr. Masa's suggestion is we take AMO model on FEs and XEs meeting. Is that correct?
I'm not sure. So, I'm sorry, Mr. Masa, and we have I don't want to give you the wrong impression. We've definitely read your memo, but there's still maybe I'm not totally clear in my mind. You're talking about the protocol building a reserve of ETH that would be used to rebalance, but so basically you're talking about the protocol buying XETH, buying leveraged ETH when the price of ETH is dropping.
Not the FX protocol itself. What I prefer is a concentrator, for example.
Right, a vault.
Yeah, as a vault, we can control those liquidity or balance between FETH and XETH on FX. What do you think?
So, but then the question is the yield on that. Like, if you create a vault that is an ETH reserve, who is paying for that? Because keep in mind that FETH is already holding FETH. You already the NAV of FETH is on the hook to pay stability if the system goes out of whack as it is. So typically for holding a leverage perp, you are paying. This is leverage perp for free. So is the idea here being that you would basically, the question is where would the money come from to pay yields in normal operation? Why would anybody deposit in this vault when the system is in normal operation?
Yeah, so for example, like POS validator reward, what about key additional.
Right, but
benefits
POS validators can mint ETH out of thin air. We can't do that. Where would the ETH that we pay as a yield for people in that vault, where should that come from?
Yeah, no idea coming from that point. So
yeah, I mean it's interesting. The protocol charges a fee, and so the protocol, so obviously there's going to be a token for the product. The protocol will charge a fee and there will be revenue distributions to token holders. One of the things that we have been toying with, an idea that's been brought up to us a couple of times, but especially by some friends in the DeFi world, is that some protocols are starting to lock, rather than having VE locked pure governance tokens, they are creating a model where you pair your governance token with ETH or whatever, like in an LP, and then you're VE locking that LP token. instead of just the pure governance token. And what you get then with the VE locked LP token is you get this like free liquidity forever, or at least for as long as the token remains locked. And then you're paying your revenues to not just token holders, but to token holders who are also liquidity providers. And once they've locked that LP token, they are liquidity providers kind of like for life. And so it dramatically reduces liquidity costs of the protocol, and it helps the revenue of the protocol to go to pay directly for like you get liquidity for free as you're distributing revenues, which is a really cool idea, something that we've been talking about. But I wonder if there's maybe a variation that you can do in this, where you could have like a where you could do something similar with a governance token and XETH, right? In order to lock up, like create some XETH supply that is kind of perpetual and that's locked and that kind of doesn't go anywhere in any market. It's a little tricky though. Like we've talked about it internally and we've kind of shied away from the idea because the idea of locking a like leverage trading token, it kind of defeats the purpose. Like of a leverage token is really good for trading. So if people have to buy and lock it, then it's like, does that make sense or not, right? Would people go for that? But maybe like, locking some XETH maybe in like some kind of a boost system, or there are a few levers that we have to pull that haven't been fully fleshed out that are specifically around the token emissions, liquidity mining, locking, and that kind of stuff that we can potentially use to address these kinds of problems. But listen, really appreciate that you're bringing these up and chiming in, talking about these. It really brings a level of discussion up and it helps a lot. We need to all keep talking about it, and you too, please.
Yeah. I think kind of lockup bonus is kind of good point here too, including our FX token itself. Longer locking FX token holder can gain some kind of additional bonus by depositing the ETH to FX protocol. That's another way to protect the liquidity or balance, supply and demand balance between FETH and XETH. That's what I'm thinking too. That's
yeah, and you kind of like help to create that. The trouble is that if you get people to lock up XETH, you guarantee that you've always got XETH in the bear cycle, but you also dilute everybody in the bull cycle, right? The more XETH that exists, the lower the effective leverage of every XETH is, right? And so when you imagine the opposite cycle and everybody is like super bullish, then the effective leverage drops. And if you've gone out of your way as a protocol to lock up a bunch of XETH, you've kind of like you've diluted everybody's XETH by forcing people to lock, and those people who are forced to lock can't even really realize those gains because they're locked.
Right.
So there's a lot of interesting sort of levers here still that I think that none of these ideas really imply much of a change to the underlying system. They're all just kind of like things that we can add and adjust on top of it in order to have it functioning optimally. Our friend Tao has been on the stage for a while and he's been keen to ask a question, so I want to open up some time for him.
Oh, thank you very much. Yeah, I do have a quick question, which is related to the protocol at the early stage, right? The whale are able to manipulate the protocol. For example, you was talking about risk management, was all talking about relate to, for example, the ETH price changing a lot, right? Then it will be going forth to the stable mode and the user balance mode. Have you considered one case, for example, just a whale, right? He have a lot of FETH and also XETH, then the price going up a little bit, then he quickly cash out all the his profitable XETH. Then because he quickly redeemed a huge amount, right? Then the protocol will be going to the like a user rebalance mode, maybe, right? Because if he's a whale, right?
If he does, yeah.
If he's a whale. But at that time, actually the FXETH, the Ethereum price is still in the like a very stable price, right? It's not like a huge, it's only about the whale itself. Then it's forced that to the FETH. Then he quickly like redeem his FETH hold, then an extra bonus. So he basically arbitrage the protocol, right? Because all your risk management is very clear with a number. If he's a whale, he should be able to manipulate. I mean,
That's
in the
true.
early stage, yeah.
So I'm going to leave that one mostly to Charlene, but before I do, there's the minor point that I would make, or the maybe major point that I would make, is that this hypothetical whale can't redeem all of his XETH without paying. Like if he's redeeming so much XETH that he's pushing the protocol out of stability, he's going to incur all of those additional XETH redemption fees that accrue when you start redeeming XETH beyond that threshold setting. Right? So he can redeem all of his XETH up to the point where, like, up to 130% CR, and the system is not in stability mode. But if he redeems past that, he's going to lose his profitability because he's going to have to pay additional fees in order to redeem XETH. The marginal XETH is below that, pushes the protocol below that threshold.
Yeah, sorry, I'm not so sure about the math, but how about he pushed very close to the 130, then he let me see, he redeemed the FETH, just like he used it because he hold both FETH and XETH.
Right, but if you redeem FETH, you push the protocol away from that risky stability mode. So if he redeemed XETH to push the CR down, and then redeemed XETH, it would just push the CR back up again. He wouldn't have got any bonuses or anything like that. He would just be basically that, like what you're describing is basically a withdrawal from the system, and it shouldn't affect anybody else. If the fees are correctly set and the thresholds are set, then yeah, anybody who intentionally redeems past, like, into stability mode is going to have to pay those additional redemption fees on the marginal amount that is like more than sort of like that pushes the system beyond that point. And so that should limit the profitability for that. Charlene, do you want to chime in and color that at all?
Yeah. So you put it right. So whenever the CR cross this stability mode, the fee is going to change significantly, right? So if you want to try to arbitrage that way, it's not going to be profitable, right? The only way FETH and XETH holders can arbitrage on each other, right, from the contract directly, is when NAV is calculated wrongly, right? And to prevent this, attack around this, so we use 30 minutes TVOP to make sure that the ETH price feed is correct. Right. So, but there are considerations going into that, right? So how long is the, this TVOP, price feed should be? That's a balanced decision between security and the cost to use that price.
How about that? For example, he withdraw most of the XETH, redeem most of the XETH, then push to very close to 130. Then he stopped, right? Then let the market decide. Then it might be crossed to another one, like over 130 for some like a Ether price change. Then he quickly redeemed the FETH to earn the bonus. So basically, he take advantage from the risk management. I haven't figured out, but I just wondering the team will be monitoring this kind of.
Yeah, there's no certainty on that trade, right? But if ETH price move naturally as market movement, right, and it's then just all reasonable.
Yeah. I mean, this to me is the key point, is that every scenario that we have discussed or hypothesized where somebody could really arbitrage the protocol requires them to know the future.
Yeah,
like
I think
even in the case you described, like they can push it close to the CR equals 130, but they can't actually earn any arbitrage until the price of ETH moves. And so if a player, basically, if somebody comes along to arbitrage the protocol who has the ability to like unilaterally move the market price of ETH, they're going to be able to do that, right? But the idea here is that in general, unless you can manipulate the price feed, and this is why Charlene talks about the using a 30-minute TWAP price to make sure that the cost of any kind of feed manipulation is just vastly higher than anything you could ever earn by arbitraging the protocol. That's kind of, you know, all these situations where like I said, where there's this arbitrage opportunity requires perfect future knowledge, or what Charlene likes to say, there's not certainty on that trade. Like unless you are certain, unless you can be certain about where the price of ETH is going next, you can't be
no.
certain on that trade.
Yeah. Okay, no. So the things is when you play the plot to calculate the rebalance mode, the like a 130, the CR is based on the current Ether price, right? You don't consider the total account. So the things is if the whale is able to manipulate the FETH count, the total number, to push the whole line close to like a 130, then he will have more arbitrage way to get a benefit from the other XETH holder or FETH holder. That's
right.
what I mean,
but,
right?
But only if the price goes down. Only if the arbitrager knows the future price of ETH, right? And if they know the future price of ETH, they're probably going to make more money on a highly leveraged short than they are on trying to arb the protocol. It's all about, but I like I don't mean to minimize your concerns, because these are really important, and we've talked about them internally. We want to keep talking about them externally with you guys. But generally speaking, every kind of way, there's no real arbitrage opportunity there that has any kind of certainty, right? It's a gamble. Like this whale that you described could change the CR threshold to close to 130 and then wait for a price movement down. And if there's a price movement down, then they could arbitrage the FETH redemption like any FETH holder could. Like every FETH holder has this arbitrage once you cross that threshold. It's not just the whale that put you there. Now you're assuming that the whale is going to have stacked up on their FETH. But the other thing to remember here too is that the protocol disables the incentives as soon as its collateralization ratio is back up. So the maximum amount that you can arbitrage also depends on how far out of whack the collateralization ratio has become. If you go, like if the whale pushes a collateralization ratio to 130 and then there's a little ETH price drop, or even like any kind of reasonably sized ETH price drop, is still going to have a relatively limited amount of profitability for that trade, right? And so the total amount you can make is only the total amount you can arbitrage is only limited to the amount that it would take to push this collateralization ratio back to 130. So again, if you knew for certain that like a major like short-term price drop is coming, you can arbitrage our protocol and you can become a billionaire overnight on every single perp platform, right? You can open up shorts everywhere and make loads of money. But that's only if you like have that future knowledge.
I see. I think I missed the one point. You will have like just a certain amount of money will be benefit, even though at that time you redeem the whole bunch, not all. The whole bunch.
That's right. Yes, exactly.
I think that's
fair point.
I think that's a key point I was missing. I was thinking like at that time you will redeem as much as you can get all the bonus. Then I say,
yeah, of course. That's a good point.
Okay.
Maybe I should. I'll take a note to myself and try to make that aspect of this risk management clearer. Basically, when we like, and maybe even on this slide here, where we say 4 progressively more powerful modes guide the system back to over-collateralization. If it falls below a level, each mode adding to the last, but then the converse of that is if it ever, like the moment it goes above that level, those incentives are shut off.
Yeah. That would be awesome. Yeah.
Okay. Thank you, guys, very much. Mr. Masa, Tao, thanks very much for jumping up here. We have gone crazy over time. I see there's lots of stuff flying in the chat. Paul Kametz, is there anything that's come up in chat that we should be addressing? Any questions that I've missed? Or you guys covered them all on the chat side?
No, I don't think so. But if Admiral or Ghost have any other questions, drop them now. And yeah, as I said, if you think of any other possible scenarios, how the protocol might be arbitrage, yeah, just drop them in the server and let's chat
Yeah,
about
and that's
it.
the whole idea of building in the open, right? Is like,
Yep.
let's make this as bulletproof as we can with as many different brains on it as possible.
Yeah, of
Exactly.
course, there will be arbitrages between the FX contract and the AMM, right? But those
Yes.
are healthy trades we want, right? Those trades actually help the market prices, the trading prices, right, to catch up with the NAV prices in the contract.
Yeah, and I mean that's another thing that I didn't really mention in this slide deck is that most users aren't going to touch the protocol. Most users are probably going to buy and sell on the AMM, and so the fact that all of these mechanisms that we're talking about, they really will kind of be like below the surface. It will most likely be for anybody who's not working in real serious size. You'll probably be just as far ahead to swap as you will to redeem if you choose to do that. All right, so let's maybe wind down there, and I'll thank everybody for hanging out and following along with us. I can say I'm going to wind down, but the call's not going to wind down because I'm hoping that Charlene has something to share with us about the macro world, which remains interesting.
Yeah, I'll keep it very short. I know this FX is going to be long. Just the key message, right? I think the market is where the market is trading has priced in that it will be raised somehow. Even though it's a political game, play again, right? It will be solved eventually before the deadline. So the next event that market will be focused on is Fed meeting in June, and a dollar index is still the leading indicator for global financial markets now. It's already trading around 103. So after all the games on the table, behind the scene, result is that dollar is winning on capital inflow. So empire is falling, but it doesn't collapse overnight. And market sentiment currently suggests a 30% chance of another rate hike for the FOMC meeting next month. So if that happens, so dollar index is set to rise even further. Few asset prices can defend against this move, except the most secured ones. And Bloomberg did an interesting survey last week on what people would buy if the US hit the debt ceiling. So gold came as the top choice, followed by US Treasury bonds. And Bitcoin and the US dollar are actually competing for the third spot. And Bitcoin is in the progress of gaining its status as safe haven asset. But from trading data, the correlation between Bitcoin, gold, and other assets have been fluctuating around. So Bitcoin has been acting a bit like Schrodinger's cat. Sometimes it's a safe haven asset, sometimes it's not. So hopefully Bitcoin and crypto will stay up there when we need them to. As yes, next month. And that's it for this week. Hope it helps.
It does
All right.
help. And by the way, I really appreciate the Schrodinger's cat reference. Although, to be clear, Schrodinger's cat is both dead and alive until you check. So it's...
It goes into your territory, isn't it?
It does. Yeah, it does. And it's way weirder than you think.
Oh boy.
Yeah.
All right,
All right.
KMX, do you have any closing wisdom for us?
I think, oh, go ahead, Charlene.
Yeah, I think there's still lots of questions in the chat channel. Should we just, hang around to answer them, or should we get people to drop in Discord?
Well, I would say, why don't we we'll shut the recording off here. And I think it's okay to hang around for a few extra minutes if anybody wants to chat. Actually, do you know what we could do is we could just jump over to the non-stage community call for anybody who wants to just shoot the shit a little bit about F of X and maybe has other questions that they want to ask or talk about. We can always spend a few extra minutes over there chatting about that. But I think we'll shut the recording off and call the official community call over after we get K Metz's closing wisdom.
All right.
Yeah, that sounds good to me. So I think the one thing that for me that's been reading this and sort of I'm kind of getting introduced to it at the same time as the community is in a lot of ways. My thoughts on it are you just kind of have to stare at it and read the white paper a couple of times and read the threads that have been put out and you just kind of have to think about it, and just kind of tilt your head to the side and kind of stare at it for a while. And because it's a complicated protocol with a lot of things that have to be in balance. That's with the yin and yang symbol, and so just keep reading about it and thinking about it, and of course, like, reach out to us with any questions or comments or concerns or anything else that you have. But no, these discussions are great, and I love seeing them.
Awesome.
Yeah, that's all I got.
Thanks everybody for coming out, and we'll jump over into the non-stage community call channel if anybody wants to come and chat for an extra few minutes. And if not, we will see everybody in the Discord and on Twitter. And will we share the slide in Twitter? Yeah, we'll get these. I've obviously, as I walked through it and saw all my mistakes, I've got to tweak those. But I'm sure we could at least get those into the Discord. If not, put them up on Twitter.
Yep, sounds good. All right.
Thanks, everybody. See you.
Okay.
So, what do you think, Cody? Did we do a better job? Is it any clearer for
Yeah
for
no
our
that
friends now?
was good. I like the charts were definitely nice. Like, I mean, I conceptually got everything after reading the white paper a bit, but nice to just sort of see it on a chart to help digest some of the different scenarios.
Yeah. Fair enough. Well,
But
it's hopefully. I mean, it's one of those multivariate things, right? Especially when we're describing the mechanism, because you've got like the supply and the NAV and the price, like their ETH reserve price, and they're all influencing each other.
yeah, it's tough to like really say or model what it does.
Yeah, exactly.
When there's like a few axes on it, so you kind of get a little bit. Need one of those 3D plot charts.
3D plots,
That'll
yeah,
be good.
You better believe. You better believe I thought about it, but I